welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Hey, as always, there's a disclaimer at the end of the show that's important for you to listen to. And, as a reminder, the CFTC is the regulator for the risk transfer markets, which include the futures markets for things like corn and wheat and soybeans, and also financial products like futures on the U.S. 10-year note and, of course, interest rate swaps. Now, with this in mind, we're always attempting to better understand these markets and how they function, and to anticipate problems before they happen, to give us the opportunity to fix them before they negatively impact market dynamics, liquidity and structure, and really market participants and everybody at home. So this week, we want to dive into the fresh U.S. economic data to see what it's telling us about the U.S. economy and about U.S. interest rates and any potential problems out there. Now, to do this, we bring on Natixis Chief Economist Joe LaVorgna. Now, Mr. LaVorgna has been an economist for over 20 years with Deutsche Bank. Joe, welcome to CFTC Talks.
Thank you, Andy. Pleasure to be here with you.
Ladies and gentlemen, for today, I just want to give you a warning. We're going to spend some time discussing the U.S. labor market. Now, the reason we do this is because we want to understand how the job market is doing and what it can tell us about the health of the U.S. economy. Now, and we do that to better understand the direction of Federal Reserve monetary policy and U.S. interest rates, or the cost of money, which, of course, impacts everything from agriculture to energy to equities. So, Joe, let's jump right into the jobs data from last Friday. What were the top three things that jumped out at you from the data?
The top three things. First thing, Andy, is we continue to get job growth at something 90, almost 100 straight months of job gains, and the 200,000-ish gain was very much in line with the recent trend. So that was the most obvious that just jumped out at me. The other is that the unemployment rate remains extraordinarily low. It's hovering near an 18-year low at roughly 3.9. My guess is it will go down more. We could talk about that. And then last but not least, we had a large 0.4 increase in average hourly earnings that pushed the year-over-year rate up to 2.9, which is a new cyclical high. Those are the three things that immediately jumped out at me.
It's interesting because everybody's been looking for wage acceleration, and we'll get to that in a minute, but I that was the one thing that stood out, and I think bond market reacted pretty strongly too, didn't it, to that data?
It did. It wasn't. It was more fleeting than permanent. But yes, the market did react to that as a fear that maybe inflation pressures could be building. Yes.
I was down in Dallas last Friday for the Dallas Federal Reserve Energy Conference, and I got to meet and listen to their president and CEO, Rob Kaplan. And one of the things he mentioned he likes to keep an eye on are labor force participation rate, and not the U3 rate, which is the headline rate that everybody talks about, the unemployment rate, but actually the U6 rate. So Joe, for our audience, can you briefly describe what these are and what they can tell us about the health of the U.S. labor market?
Sure. And let me preface my remarks, Andy, by saying with many of these figures, the employment, the wages, the unemployment rate, and now the U6, all these numbers are snapshots. They're based on surveys. This isn't physics. It's not mathematics. There's a lot of range of error, and these numbers get revised or they change a lot. So we need to sometimes look at these figures as too much granularity. Right. Having said that, the U6 takes the unemployment rate, which everybody knows what the unemployment rate is. You either have a job or you don't, assuming you're part of the labor force, and that rate is low at only 3.9%. What the U6 does is it tries to create a broader measure of labor slack or labor market health. So what it does is it includes part-time people who want to have a full-time job but are being forced to work part-time, and it also includes people who don't have a job, but because they're not looking, they're not included. Those people are known as discouraged workers. So when you take the number of unemployed plus the part-time workers who want full-time employment plus the discouraged workers, and you take those three figures, you add them up and you divide them by the size of the workforce, that gives you a number of 7.4%. That was down 0.1 from where it had been. It's the new low for the cycle. So broadly speaking, the labor market is getting better. It's getting healthier. More and more people are getting the types of jobs that they want. And as we just discussed, some of them are getting paid a bit more as well.
Well, that's great. So how about the labor force participation rate?
So participation measures the share of people who are part of the workforce, and it's only around 63%. It actually fell a few tenths last month. It's been kind of stuck in the low 60s for a while. We would really like to see that up around 70%, meaning you want more people part of the workforce than what the numbers are showing. And there's reasons why. No one's exactly sure, but there's reasons why participation has stayed low. Part of it is secular. The population is aging. You've got the baby boomers who now are retiring, but you also have young people who are in the workforce, who are starting the workforce later. They're going back to school. They're not necessarily entering quickly. And we're also seeing some people just not partake in the labor market for whatever reason. But that's something that I'm watching very closely. And for this to be a more robust recovery, my guess is we're going to need to see that participation rate, if not move up to 70, certainly get up into the mid to high 60s, 65%, 66%. That may not seem like a lot from the roughly 63% I alluded to, but a few extra percent could really help extend this business cycle and help perhaps back off on some of these anticipated Fed rate hikes.
Yeah, I guess if the labor demand is strong enough, you're going to get people who are sitting on the sidelines to come back in, and also the people that have part-time jobs to maybe, hopefully, keep your fingers crossed, turn those into full-time jobs. And that number going up is a good indication that positive things are happening for the economy.
Right, that people don't want to miss out on the good things. They may be sitting at home or not be persuaded to come into the workforce, but if they think they're passing up a good opportunity, higher pay, good benefits, etc., they're going to come back in. And there's been some anecdotes that might be happening. We just don't see it broadly yet in the actual economic data. But maybe it still happens. I'm optimistic, Andy. We're going to get there.
Or even businesses can say, look, we don't see the skill sets that we want. We're going to hire people and train them to fill the roles that we need, right? I mean, that could be happening as well.
Yes. Right. It's interesting because, the Republicans, they don't want rates to go up because they're the party in power. They want to keep the economy going as long as possible. And if something bad happens down the line, then, we'll cross that bridge when we get there. And then the Democrats, Yellen, I'm assuming is a Democrat, but she's a former Fed chair. She said that a tight labor market was the best thing for job retraining, which gets exactly to the point that you have. So I would argue politically there's incentive for both parties to let this thing run. I just get worried, Andy, and we've talked about this before. The Fed is just pretty much bent on raising rates because they're slaves to economic models that don't work. Now President Kaplan isn't one of those people, and Jerome Powell, the chair, isn't either, I don't think, but there's still a lot of people on that FOMC committee, and certainly those running the forecast at the board that erroneously believe that too low unemployment, and too low, I put parentheses around that, causes inflation, and I don't believe it.
Well, I guess that gets to the question of how low do you think the U.S. unemployment rate or the U3 can go, and I want to say that there's some questions about what in the economic field, and this is your field, Joe, obviously, the questions over the natural rate of unemployment and what that actually is. And I think, correct me if I'm wrong, I think Chairman Powell came out last week or the week before and said, maybe not all these statistics should be just adhered to, and maybe we should take a bigger picture view of what they're telling us.
Right, that's right. That to me is a very pragmatic, non-academic approach, which to my mind is the right approach. So to answer your question, Andy, we don't know. The economics profession does not know what the natural rate of unemployment is. But we also know that very seldom in economics do we get any natural experiments, not even like other social sciences, oftentimes like psychology, that can run studies and experiments. Economics have them, but they're not as frequent. Having said that, let's find out where that natural rate of unemployment is. Let's run the economy hot and see where it is. Maybe it's 3.9 now. Maybe the natural rate is 3.5 or maybe 3. But let's see. What's the worst that could happen if we discuss that? We find out rather that it's lower. You get some inflation. Big deal. I don't understand what the problem is.
Well, I guess the question is, since we saw a jump in wage gains, right, that we're starting to see strong wage gains, which is good to some extent because they haven't been strong for a long time. My question to you, Joe, is do you consider wage gains a precursor to inflation?
No, the correlation between wages and prices is close to zero. And that reflects a few things, not the least of which being that wage growth typically is a function of productivity growth. In other words, you get paid more when you can produce more, and you've had low productivity growth, so you haven't had much wage growth. And the other story is that sometimes these higher wage gains could be absorbed in profit margins. But again, if you look at what the Fed focuses on, this PC deflator, headline and core, really since the mid-'90s when inflation got down to around price stability, 2%, both of those data points, Andy, have averaged less than 2% over those past 23 years. So given where we're starting from, I don't understand what this concern is that there's going to be some inflation genie that's going to come out of the bottle and scare us and have a major problem. I mean, I'm not saying that the Fed should be irresponsible in running monetary policy, but it seems to me that the Fed should be very cautious in raising rates. And Powell rhetorically seems to give us those words, but when we look at the Fed's forecasts, boy, there's a lot more tightening coming from what the Fed is saying versus what's priced into the fixed income markets, which tells me that the yield curve, my mind, is going to invert before the year's out if the Fed continues along this path. And that's typically not a good sign for the longer-term economic outlook.
Right. Well, let's hold off on the yield curve for just 1 second, because I want to get to that, and I think it's a great point. But let's bring this back to the Fed. I mean, how will the FOMC view the jobs data, and what is your expectation for the path of monetary policy this year?
So they're going to view it very much like, okay, we're going to hike in September, right? That was basically 100% priced into the market, and then we're likely to follow. And the Fed, this is the Fed I'm talking about, likely to follow up in their mind with another hike in December, and then reiterate their intention or its intention to hike rates at least 3 times next year and 2 more times in 2020. And it very well may be that they bring one of those hikes forward into 2019 or even add an extra hike. So in other words, when they look at the data, they're going to say, wow, this economy it's growing really well. Wages are picking up. Current quarter GDP might be well over 4%. It looks like we're going to run 3% plus for the year. It hasn't happened. That hasn't happened in a long time. I mean, they're going to look at these numbers and say, oh, geez, maybe we have to hike more. And you hear that from some of the Fed hawks. So that's my concern, is that this just what the data are doing is validating the Fed's bias, if you will, and I use that word sort of carefully, but bias to want to hike more.
Yeah, that's certainly. I think there have been a couple other Federal Reserve folks that came out and said that they may have to think about either a longer tightening cycle or more rate hikes coming sooner. And I think some of that came out. I think Boston's Rosengren said something along those lines. I don't want to quote that. That's not me saying that, but
you're right.
Something along those lines, right?
Yeah, so I mean, Kaplan, who you referenced at the outset, he's more be cautious. Bullard from St. Louis and Raphael Bostic from Atlanta. Those 3 gentlemen have been more cautious, and I think properly so in terms of what the Fed should do. But I would argue, based on my tally of Fed speak, if you will, those 3 people are in the minority.
Mm. Well, let's get back to the yield curve, because there's been a lot of discussion about the flat yield curve this year with the spreads like the U.S. 10-year, 2-year dipping below 20 basis points. By the way, everybody, the markets watch that, because what they're looking for is what Joe mentioned before, an inverted yield curve where short-term rates are above long-term rates, because it has a great track record of indicating a recession, unlike most economists. Sorry, Joe.
Oh, yeah, no, absolutely. Listen, I'm going to be the first to criticize, Andy, the profession, which seems to be more about economic modeling and who's the most clever and who sounds the most intelligent versus being correct. Right. So the profession has done itself a lot of disservice. I take no offense.
Okay, sorry, I just was kidding you there. But what's your view on the yield curve? I mean, you said there's a risk that it could invert. And,
sure.
You know, I'm trying to remember off the top of my head how many times an inverted yield curve has led to, I think, in anticipation, 12 to 18 months of a recession.
Right. So, I mean, essentially, since the early 50s, there's only been one false positive, which was in 66. The curve inverted, and then you didn't have a recession until 69. So basically one miss out of, let's say, 10 or 11 recessions, depending on if you want to count the short a recession in 1980. But the curve has typically been very good. Now, what you hear from people is that the yield curve really has kind of lost its significance because of Fed manipulation, which on the surface that would seem to make sense. The thing is, though,
Joe, just let me stop you. That when you say Fed manipulation, I just want to be really clear what we're talking about here. That's their quantitative easing program, right? The increase in their balance sheet. Okay.
Right. Yes. Right. Exactly. Yes, that's exactly correct. So the Fed has this balance sheet. It's over $4 trillion in size, and they've also used forward guidance to take risk premium out of the long end. So all these things help keep rates low, and people are saying, well, given this extraordinary situation that the Fed and other central banks are in globally, the yield curve doesn't send the same signal it does. Okay, and on the surface, that kind of makes sense. However, this year, the Fed has been letting the balance sheet unwind. At the same time, we had a massive tax cut with historically low unemployment rate. And a lot of people said that's never happened before, and that should be inflationary. Okay, what has the yield curve done during this period? It's actually flattened more. So yes, there's reasons why the curve may not necessarily send the exact same signal, but the fact that it's been flattening so massively when in reality there would be some factors you think that would put a steepening bias in play. The fact that it hasn't happened tells me that the market, if nothing else, if it's not recession, certainly the yield curve doesn't seem to have any concern at all about inflation pressure. And I should also note, Andy, that the U.S., with few exceptions, is one of the highest yielders in the world in terms of interest rates. So if everybody's doing QE, then in some sense the manipulation, if you will, by central banks is less relevant because everybody's doing it. It's all the same. And yet the curve continues to flatten as you highlighted. And that, again, tells me there's very little inflation risk, but potentially the market's setting the signal that at some point in the next 12 to 18 months, there could be a downturn. And that's my big, big concern.
Well, in support of what you're saying, I think the San Francisco Fed put out a paper something along the lines of on the yield curve, like this time it's not different. It's something along those lines.
Yeah.
But basically, what they're saying is they're supportive of what you're saying, which is no, the yield curve is actually telling us what it has always told us. And so I think that's an interesting point. But I guess my question, and this is where it gets fascinating to me, is why is the longer end of the yield curve so sluggish to respond to higher economic growth that we're seeing now? Is it telling us something that the market's anticipating an economic slowdown in the near term, like in 2020 or 2021?
Basically, yes. I mean, the market is basically telling us that it doesn't think the Fed funds rate is going to average 3 and change, 3 3/8, or wherever the Fed has. But I think the Fed's longer-term forecast is closer to 3. But in any event, the 10-year note is saying that it does not believe over the next 10 years that the Fed funds rate is going to average anything close to 3%. So it could be the growth story weakening. It could be the next recession and the possibility that there's negative rates in that downturn. Certainly the market doesn't believe that there's going to be an inflation fear of any sort. But maybe growth can turn out to be better. But the question you raise is one that, there's no hard and fast answer to. But certainly what we've learned really since before the financial crisis, or as it was unfolding back in August of 2007 when it first started, what we've learned, Andy, is that fixed income markets have an awfully good ability to kind of sniff things out before equity investors and any of the broader economic data sees it. So that's why we're not sure why the mechanics of the market doing what it's doing are clear. You have to always be, I think, respectful of what those markets are telling us. And right now, as I said, they're not telling us there's really much inflation risk, and therefore if the Fed continues to hike, the likelihood of inversion goes up significantly.
Yeah, and I was just thinking, coming from the land of commodities here, we've seen the U.S. dollar strengthen against emerging market currencies. We've also seen, obviously, with higher interest rates, that's putting pressure on in the agricultural space. I mean, you think about land prices; those prices are low because ag prices are low, and that puts obviously some questions about that sector into play here. How do you look at EM? I mean, how do you look at what's going on with higher U.S. interest rates and a stronger dollar, and how that's playing out in the EM markets?
So the thing is, I mentioned that the long end U.S. yields are, Italy is just slightly below our yield, but I mean, our 10-year yield is higher than almost everybody's, with the exception of Greece and a few other countries. So our long rates are high, but our short rates are also rising because of what the Fed's doing. And those short rates are also very high relative to much of the world. And what that's done, Andy, is it's helped, and the U.S. economy's performed well. So what's happened is you've got rates going up as expectations of growth, in part fueled by the tax cut, improve. So that's led to inflows into the U.S. That's helped bid up the dollar, and that dollar has risen dramatically, especially vis-a-vis emerging market currencies. And the problem, of course, is a lot of these emerging markets, through QE over the past 5, 6, 7 years, have bought and issued a lot of dollar-denominated debt. So when that interest rate in the U.S. goes up and the flows come in and the dollar appreciates, it puts tremendous pressure on emerging markets that they then have to defend their currencies by effectively raising rates. Or in some instances, and this is a fear, is if the Fed keeps raising rates, there will inevitably be some defaults because people can't, I'm guessing a lot of these bond issues weren't hedged. They weren't swapped back into the local currencies. So therefore, there is a real risk of default and market pullback. So that's something to watch. If you listen to a lot of the key emerging markets, I mean, for example, the recent central bank governor of India spoke about this over the summer, said there was a potential crisis effectively brewing. I'm paraphrasing. If the Fed kept raising rates and because of the implications it would have on EM, which could be quite significant. So we're seeing this play out now, and my guess is the Fed continues to hike and doesn't relent at some point, EM will become a bigger issue. And if EM growth slows because of the currency, that's ultimately, Andy, going to filter back into growth prospects and, of course, U.S. earnings and obviously stock prices.
Well, I'm glad you brought up India because I'm thinking about the editorial that the central bank governor wrote and posted in the FT. And then he went beyond that. He actually raised interest rates to protect their currency. And I think if you look at Turkey, Brazil, Argentina, India, and it just kind of permeates out from there, some of those stock markets are in, what we would call bear markets because they've fallen 20%, and certainly the incredibly rapid decline of the Turkish lira should make everyone sit up and take notice. So those are great points. All right, last question before I let you go. I want to. I always test people a little bit on this, but I want to ask you a hypothetical. If you could know something 1 year into the future to help you understand the U.S. economy and where it's going, what would that one thing be?
I can't say when the peak in economic activity is, would it? Can I say that? Could I say when GDP tops out, or that's too obvious?
Well, it's a little obvious, but that's okay. Sometimes the obvious is the most important thing to look at.
Okay, so you
look at GDP.
Right. So I would say, if you could tell, so if we knew when the NBER, our National Bureau of Economic Research, was going to date the peak in the business cycle, we would know with roughly 4 to 5 months we should get out of equities right before, if it was December, I'm making this up, hypothetical, be December next year, say the recession. I don't think there's a recession next year, but if we knew the peak in economic activity was next December 2019, then we want to really cut our equity risk sometime in July, August, the latest, and then earlier in the year, we'd be wanting to get out of high yield and some investment grade credit where those spreads tend to widen quite dramatically. And then, of course, if we knew the recession was in December of 2019, then we could kind of basically a year later from when, basically we started de-risking in July and August. If we started re-risking in July of August of 2020, right as things were still pretty lousy, we hadn't come out yet, we could probably do really well with equities recovering quite dramatically. So basically, if you kind of knew this is why everybody tries to time everything, Andy, is that if you knew when things peaked, you could have a very good investment track record in terms of your performance. Of course, if we're only that easy.
Well, you make it sound that way, so that's good. All right, Chief Economist from Natixis, Joe LaVorgna, thanks for coming on the show today.
My pleasure. Great talking with you, Andy. Thanks for having me on.
You bet. That's our show for this week. If you want to listen to more podcasts, you can go to our website at cftc.gov and click on the podcast button. Or you can go to the podcast button on your phone, type in CFTC Talks, and click subscribe to get them every week if you want them. On the shows, we cover everything we watch at the agency, from interviews with Nobel laureates like Robert Shiller to VCs like Alex Rampell from Andreessen Horowitz to key government officials like the USDA's Secretary Sonny Perdue. Check them out. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks.
Wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.